In August 2026, a military standoff between the United States and Iran essentially shut down some of the most critical waterways on Earth. The immediate logistical impact left massive commercial ships stranded in open water, freezing vital supply chains. That freeze quickly translated into domestic pain. Across the U.S., gas prices surged by 34%, pushing the average well over $4.09 a gallon. Hitting consumers directly in the wallet created severe political fallout, forcing the U.S. president to scramble for immediate de-escalation to save his approval ratings. But right in the middle of this geopolitical freeze and supply chain panic, the world's largest oil companies released their second quarter earnings. This chart tracks those Q2 profits. Exxon's earnings doubled compared to the previous year, spiking to $14.5 billion. Chevron saw a 400% jump, pulling in $12 billion, while BP netted $5.7 billion of its own. President Trump publicly attacked these numbers, telling reporters the companies were making too much money based on a shortage. In almost any other industry, a severe supply chain disruption destroys revenue. If you can't ship your product, you lose money. Why then does a global oil shortage inherently generate record-breaking billions for big oil? To understand why, look at this map of the Middle East. The global supply chain relies heavily on two narrow, vulnerable maritime choke points, the Strait of Hormuz and the Bab al-Mandeb. During the standoff, Iranian-backed Houthi militias began aggressively targeting commercial shipping attempting to transit these waters. As this animated route shows, the threat forced commercial vessels to abandon the Red Sea and detour around the continent of Africa. That adds roughly 15 days to a standard journey. Taking the long way around massively slashes the daily flow of crude oil through the entire region by a staggering 50%. It also inflates the cost of fuel, crew wages, and maritime insurance for the active ships. This physical bottleneck triggers panic in the international markets regarding an impending scarcity of oil. BP CEO Meg O'Neill defended her company against the political backlash by pointing to a basic economic fact: oil companies produce a global commodity. This flowchart illustrates what that means in practice. Oil companies don't set retail prices based on their own localized extraction costs. Instead, global traders set the market price based on worldwide fear and demand. Meanwhile, the cost of physically pumping oil out of non-conflict zones, like offshore rigs in the North Sea or the US, stays exactly the same. This graph visualizes the math behind the windfall. The bottom line tracks the static cost of extraction, which remains flat. The top line tracks the market price, violently spiking upward due to Middle East panic. That massive gap in between is pure profit. Big oil companies don't have to pump a single extra drop of crude or alter their daily operations to make billions more. They simply ride the wave of global geopolitical panic. Back in the political arena, U.S. and Gulf state leaders are left to frantically negotiate and make military concessions to calm those very markets. While politicians scramble to manage the fallout and protect their economies, the oil majors sitting at the top of the supply chain remain insulated from the chaos. Consumers often picture executives in a boardroom actively choosing to gouge prices at the pump. But the reality of this vast, automated infrastructure is that the system inherently rewards them during a crisis, without anyone ever pulling a lever. When a global conflict strikes, politicians absorb the risk, and everyday consumers absorb the cost, while the corporations are mathematically shielded. This dynamic exposes a lasting reality about our global energy infrastructure. As long as the world relies on a highly centralized and physically vulnerable commodity to function, regional instability will always guarantee price shocks. The record-breaking profits seen during the 2026 war represent the standard economic reaction to fear. The system is functioning exactly as it was designed to. When the world bleeds oil, big oil makes billions.